All right, looks like we're live. Welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker HEAR, Turtle Beach Corporation, Turtle Beach Headphones, another company that we've covered a couple times on the stream before, and is a personal holding of ours and has been for some time. It's definitely come down pretty significantly in the recent months with a lot of the tech decline. Um, it's very similar to another company that we did very recently, Corsair Gaming, and a lot of the things that we covered in that particular stream is definitely going to be relevant to covering the stream, particularly how we're going to model the revenues, because they basically are in very similar industries, or at least largely overlapping industries. So we definitely have to take the projections that we took into account for that company into account for this one, but we will get into all of that after we've finished doing all the numbers normal. There are a few things are in place. Looking at our list of companies that we've kind of been going over for the last month or so. As I was saying, we're doing Turtle Beach today. I did notice that the 10K for Shell, or I should say the 40F actually, because it is a foreign company. So the foreign annual reporting, the 40F filing came in for them. So I do think that'll probably be the next stream we're going to do. However, this week I'm not going to be doing a stream tomorrow, as I've been doing for the last several weeks, doing a Saturday stream to kind of keep pace with the earnings season. I can't do that this week, however, so we're going to be skipping the Saturday stream. So Shell will probably be our stream for Monday. But either way, as far as economic data, we had the consumer price index report come in yesterday, a bit hotter than expected again. And I think now the year-over-year number is at 7.9%. Obviously that's from February, so no telling what the recent effects of the change in various commodity indexes have had over the last month due to the Russia crisis. This is basically mostly it being priced in prior to that, although there's a little bit of February that would be included in there. Either way, it's expected to keep up again next month. And it's worth noting that while it is around 7.9%, I believe it is at like 5.9% if you do the X food and energy costs. So if everybody tries to tell you that it's like, oh, well, it's just gasoline and food costs because of supply things like that, yada yada yada. Well, not really entirely true, because it's still at like almost 6% or something in terms of the core CPI. But either way, we're gonna get into Turtle Beach, not really talk too much about that stuff today. Getting into some of the prep work that we usually cover for all the companies before we get into stream. They basically have no debt. This company, they have $8 million of lease liabilities at a weighted average maturity of 6 years and an interest rate of 3.75%. But compared to the $361 million market cap they're trading at, that means they basically have no debt, about 2% or so. And the only segment that we're going to be keeping them in terms of is the computers peripherals segment with an unlevered beta of 1.1, and it'll probably be about 1.1 since they basically have no debt. And a sales capital ratio of over 2 with a net margin of over 20%. So overall a high quality industry to be in, with generally considered a decent amount of volatility as a result of it. They do have about 20% of the revenues coming from Europe, about 9% in the UK, 66% North America, and 6% other. And then a decent amount of their production relative to all that is in the US. So we will play the fourth quarter earnings call while we do the numbers. I've already put in the first year of numbers, as is pretty normal. I did also put in some of the revenue numbers here because I was needing those while making some projections, but that's all I really did for that. So I will play the fourth quarter earnings call while I work. Oh, hush my.
Good afternoon, ladies and gentlemen, and welcome to the Turtle Beach fourth quarter and full year 2021 conference call. Delivering today's prepared remarks are Chairman and Chief Executive Officer Jurgen Stark and Chief Financial Officer John Hanson. Following their prepared remarks, the management team will open the call up for questions. Before we go further, I would like to turn the call over to Alex Thompson of Gateway Investor Relations, Turtle Beach IR Advisor, as he reads the company's safe harbor statement that provides important cautions regarding forward-looking statements. Alex, please go ahead.
Thank you. On today's call, we'll be referring to the press release filed this afternoon that details the company's full year and fourth quarter of 2021 results, which can be downloaded from the Investor Relations page at corp.turtlebeach.com, where you'll also find the latest earnings presentation that supplements the information discussed on today's call. Finally, a recording of the call will be available on the Investor section of the company's website later today. Please be aware that some of the comments made during this call may include forward-looking statements within the meaning of the federal securities laws. Statements about the company's beliefs and expectations containing words such as may, will, could, believe, expect, anticipate, and similar expressions constitute forward-looking statements. These statements involve risks and uncertainties regarding the company's operations and future results that could cause Turtle Beach Corporation's results to differ materially from management's current expectations and any forward-looking statements made during this call. While the company believes that its expectations are based upon reasonable assumptions, there can be no assurances that its goals and strategy will be realized, and numerous factors may affect actual results and may cause results to differ materially. So the company encourages you to review the safe harbor statements and risk factors contained in today's press release and in its filings with the Securities and Exchange Commission, including without limitation its annual report on Form 10-K and other periodic reports, which identify specific risk factors that also may cause actual results or events to differ materially from those described in our forward-looking statements. The company is under no obligation to publicly update or revise any forward-looking statements after this conference call. The company also notes that on this call it will be discussing non-GAAP financial information. The company is providing that information as a supplement to information prepared in accordance with the accounting principles generally accepted in the United States, or GAAP. You can find a reconciliation of these metrics to the company's reported GAAP results in the reconciliation tables provided in today's earnings release and the presentation. And now I'll turn the call over to Juergen Stark, the company's Chairman and Chief Executive Officer. Juergen?
Good afternoon, everyone, and thank you for joining us. I'm pleased to discuss our strong full year and fourth quarter 2021 results, and I'm especially proud to announce that in 2021 we delivered the highest total revenues in the company's history following our record year in 2020. We also delivered $36.6 million in adjusted EBITDA, in line with our previously provided guidance range. While we delivered another year of growth, 2021 certainly had industry-wide challenges. Semiconductor constraints limited our sales, shipping times were much longer and more unreliable than normal, and air freight costs hit over 4 times normal levels. The holiday period suffered from lower retail foot traffic, disappointing AAA video game releases, and Xbox and PlayStation console availability constraints that impacted the console accessory market. Our success, despite the challenging operating environment, is a testament to our team's hard work, operational execution, excellence, and commitment to our brands and customers. Our 2021 performance reinforces our belief that our diverse portfolio, expert operational management, and strong consumer demand for our products have us well positioned for future success. We continue to believe that the gaming market remains the market to be in, and we expect pent-up consumer demand for the latest Xbox and PlayStation consoles to result in strong hardware and peripheral sales over the next several years as supply constraints ease, new games emerge, and gamers level up their gaming accessories. Last year, our Turtle Beach console headset brand maintained our market share of 40% or more in the U.S. for the 12th consecutive year. And per Newzoo's U.S. Consumer Insights report, Turtle Beach has the highest brand loyalty among active console gamers. We're dedicated to ensuring our fans are happy not only with their products, but with their entire experience with us. Per U.S. NPD retail data, Turtle Beach continued with many market-leading headsets throughout 2021. In fact, Turtle Beach headsets represented 5 of the top 10 bestsellers and 11 of the top 20 bestsellers in 2021 in terms of dollar sales. Our wireless Stealth 600 Gen 2 and Stealth 700 Gen 2 headsets were Xbox's most popular headsets throughout the year, as the first and second best-selling Xbox headsets on the list. For PlayStation, our Stealth 600 Gen 2 and Stealth 700 Gen 2 products were the second and third best-selling headsets. It's important to highlight that this was despite semiconductor constraints that limited our ability to sell these ultra-popular Xbox and PlayStation wireless headsets. I'll cover more about our wireless Xbox and PlayStation headsets in a moment. In addition to best-selling console headsets, our first-ever gaming controller, the Recon controller for Xbox, performed well and proved to be a strong entry into this new category for us. Since being revealed, the Recon controller has gained multiple new placements at major retailers and has been met with great reviews. Of note, the Recon controller for Xbox was recently named a Best Xbox Controller by IGN with a 9 out of 10 review score and Editor's Choice accolade. In our new gaming simulation accessories category, we launched our Velocity One flight simulation control system in November. Since its debut, the Velocity One Flight has generated significant consumer demand and critical acclaim. In fact, in November, our pre-orders sold out in less than an hour globally and in under 15 minutes in key markets, clearly indicating that we have delivered a great first product into the flight simulation category. Given the strong start and positive community chatter, we expect this product to continue to sell well in 2022 and onward. We also continued significant progress across our Rocket PC gaming accessories business. In the fourth quarter, we unveiled the Arctic White version of Rocket's fan-favorite Vulcan TKL Pro keyboard, adding yet another option to our award-winning PC gaming keyboard series. We launched a new family of Sense mouse pads with various sizes, shapes, and textures. Additionally, we expanded our mobile gaming lineup by launching new wired gaming earbuds in Asia with plans to bring them into additional markets and add a wireless option in the future. We also announced a new partnership with the popular online personality, gamer, entrepreneur, and businesswoman for the world-renowned Team Ninja brand, Jessica Blevins. In 2021, we launched 23 new Rocket PC gaming accessories and announced 12 new partnerships as we continue to broaden our PC portfolio and the Rocket brand. As a good metric of our progress, we gained share in all core PC markets, accessories markets, outperforming the competition and again growing our PC business at a rapid rate. The PC gaming accessories market for headsets, keyboards, and mice has now grown to $3.8 billion, and we will continue our investments to capture an increasing share of that market. We acquired Neat Microphones in January of 2021, which brought us a highly skilled team, the team that built Blue Microphones before creating Neat, and gave us a great advantage in creating cutting-edge microphones. In 2021, we launched 4 new products under the Neat brand. In the fourth quarter, we launched Neat's sleek Skyline USB conferencing microphone, which is great for working from home or in the office. We also launched Neat's flagship product, the eagerly anticipated King B2 XLR microphone. At the end of Q4, we added the Bumblebee 2 USB microphone and Worker B2 XLR microphone to Neat's 2021 lineup. These new products enable us to pursue the market for streamer and creator microphones that totals over $2 billion. As I noted last quarter, across all our product categories, we have also made targeted investments in geographic expansion, particularly in Japan and Korea, where we have developed new distribution and retail relationships. The investments in sales and marketing paid early dividends with year-over-year revenue growth in Asia of well over 100%. Asia holds tremendous potential, and I'm encouraged by the excellent progress we've made there in 2021. Next, I'll turn it over to John to cover the financials in further detail, after which I'll provide commentary on our outlook and the continued progress we're making in the new year. John?
Hey, thanks, Jurgen, and good afternoon, everyone. As Jurgen noted, we are pleased to report revenue of $366.4 million for 2021, the highest in the company's history, compared to our previous record of $360.1 million in 2020. As we've discussed, our 2021 revenue was actually constrained by limited wireless semiconductor components. In 2021, gross margin was 35% compared to 37.2% in 2020, which was due to the global increase in freight costs and more normalized holiday promotional activity compared to 2020. Operating expenses in the full year 2021 were $108 million compared to $84.6 million in 2020. The increase was predominantly driven by the full year run rate of costs added during 2020 to support a more than 50% increase in revenues from the prior year. A record number of new product launches, geographic expansion, and marketing investments to support those growth activities. Our full year adjusted EBITDA was $36.6 million compared to $61.4 million in 2020, which reflects the items I just covered. Adjusted net income for the full year in 2021 was $20.2 million, or $1.11 per diluted share, compared to $36.3 million, or $2.22 per diluted share in 2020. Our effective tax rate for the full year was 12.1%. Full year 2021 cash used for operating activities was $0.3 million, compared to cash generated totaling $51 million a year ago due to lower operating income and increased inventories driven by longer transit times and supply chain risk mitigation actions. Turning to the balance sheet, at December 31, 2021, we had $37.7 million of cash and cash equivalents with 0 debt, including no borrowings on our revolving credit line. Inventories at December 31, 2021 were $101.9 million compared to $71.3 million a year ago for the reasons I just noted. As supply chain risks subside over time, we plan to reduce inventory levels. The company also repurchased nearly $5 million in stock during 2021. Looking at the fourth quarter of 2021, net revenue was $109.4 million compared to $132.9 million in the same period a year ago. Like others in the gaming market, we were impacted by a slower holiday season, mostly due to disappointing AAA video game releases, constraints on new Xbox and PlayStation availability, and weak retail traffic, as we noted in our pre-announcement back in January. Revenue phasing was unusual in 2021 as the first half of the year benefited from the exceptionally strong sell-through driven by stimulus checks and some continued lockdowns, as well as significant channel replenishment in the first quarter. Gross margin in the fourth quarter of 2021 was 32.5% compared to 35.8% of the year-ago quarter. This decrease was mostly due to increased freight costs, a more normalized
Right, one more year and we'll do our 5-year trend,
and reduced operating leverage. Operating expenses in the fourth quarter of 2021 were $29.3 million compared to $27.6 million in the 2020 period. The small year-over-year increase was due to the incremental product development investments in the new categories we entered in 2021 and continued expansion of our PC accessories portfolio. In the fourth quarter of 2021, we reported adjusted EBITDA of $9.6 million versus $23.6 million in the year-ago quarter. The year-over-year change was mainly driven by the reasons cited above. Adjusted net income for the fourth quarter of 2021 was $2.8 million, or 16 cents per diluted share, compared to $14.8 million, or 84 cents per diluted share in the corresponding period in 2020. Now I'll turn the call back over to Jurgen for additional comments. Jurgen?
Thanks, John. As we said, we're pleased with our 2021 results, which again demonstrated our ability to achieve strong operational execution in spite of challenging external circumstances like semiconductor shortages, increased freight costs, and shipping bottlenecks. Our execution across our respective business categories allowed us to launch a record number of new products and deliver a 10% EBITDA margin despite this backdrop. Had we been solely dependent on the performance of our leading console gaming headset business, we would not have achieved growth, given that the console gaming headset market declined mid-single digits year-over-year. Instead, revenue growth in PC accessories and successful entry into controllers, flight simulation, and microphones provided a top-line benefit and enabled growth following a record 2020. Let's move now to our outlook for 2022. For the full year 2022, we expect revenues to be approximately flat, plus or minus 5% from our record 2021 revenues. The midpoint of this range reflects anticipated growth in sell-through and share gains in all categories, offset by reduction in channel inventory and the expectation that console and PC markets may decline somewhat from 2021, given the absence of stimulus checks and stay-at-home orders that drove an exceptionally strong first half in 2021. The first quarter of 2022 is also impacted by slower channel replenishment as retailers bring post-holiday inventories back to normal levels. We expect quarterly revenue phasing to be more normal in 2022, following several years of abnormal quarterly revenues driven by lockdowns and other COVID-related impacts. So as we previously communicated, shareholders and analysts should track our progress on an annualized basis versus individual quarters. That said, we anticipate our quarterly revenue phasing in 2022 to be roughly 11 to 13% in Q1, 17 to 19% in Q2, and around 70% in the second half. Next, this year we expect gross margins to be roughly 2 to 3% below our mid-30s target range, which reflects a roughly 3 to 4% impact from higher freight.
All right, so we'll take a pause there while we do our 5-year trend. Lots of things to kind of note here. Starting with the sales to capital ratio, as we typically do, you can see they have a very strong sales to capital ratio, averaging over the entire time frame of 2.95 or 3.06 for the last 3 years on average. So very strong, especially relative to the industrial expectation that we have 2.02. So they're definitely hitting their expectation, but also exceeding it, which is very, very good to see. You can see as far as the PE ratio goes, they traded pretty cheaply during 2018, 2019, and 2020, definitely spiking up in 2021 with a lot of the growth expectations on the back of the pandemic. They were talking about how they were getting a huge demand inflow from the stimulus and how a lot of that has started to subside. And so that's created a little bit of a difficult comp year for them in 2021 relative to 2020. Which is part of the reason that they've declined so dramatically here, because there was expectations a year ago that the EPS was going to decline this much, but here we are a year later and people are just still setting in on it. I myself have chosen to hold through a lot of the pain, partially just because I consider their balance sheet basically immaculate, and they do have a pretty decent market share position, even if I don't consider their products to be the highest of quality. It may be interesting to note, like I said, that I'm also a shareholder in Corsair and I value both of them as well. It may be interesting to say, it's like, well, why are you investing in both these companies? Isn't Corsair kind of competing with Turtle Beach? And it's like, well, in about half their business they are, but there's also parts of each of their businesses that are not overlapping with each other. But one of them I consider a higher growth play, while Turtle Beach I consider more of like a value kind of situation. They're both, but Turtle Beach I consider more directly undervalued, while Corsair I do believe growing into a market much more equivalently. But either way, looking at this balance sheet, you can see 94 million assets 5 years ago versus 230 million now. 193 million of those assets are current assets in the current time frame, only 38 of that being cash. A lot of it is in the inventories. They were talking about how the inventories have built over the last 2 years, partially as a result of the pandemic and the shutdowns, but they've also said how a lot of their sales slowdown has come on the back of slowdowns in orders and flow and stuff like that. So being able to have the inventories on hand is going to make it easier for them to deal with the next year or two, but they do need to manage those inventories. And they were also talking about in the call too, saying that they're going to work pretty judiciously to try to get this inventory number down. If I don't see this inventory number come down over the next year relative to, as a percentage to their overall asset base or their overall shareholders equity, then I'd probably be a little upset. But it would be this number as a percentage of their total assets that I would be concerned with. Because if they grow their asset, if the inventory stay the same or grow ever so slightly, but the asset sheet, the total balance sheet increases dramatically, then I'd be fine with it. Anyway, going further up into the cash flow statement, they have a fantastic return on invested capital. You can see this is just amazing over this entire 5-year period, even the 3-year average about 33%. And that comes with basically no real major leverage. The overall return on equity is a little bit lower than the returns on capital for several of the years, partially because they had the negative return on equity for a little bit before that. So they're still kind of playing keep up on the equity game. But with this type of return on invested capital, it's quickly going to turn around. Overall cash flow over the 5-year period, not really anything to speak of. Total sum over the 5 years of 13 million in total, and they've actually diluted their shareholders about 10 million during that time frame. So it's not really about cash flow in the near term. They've mostly just kind of been working to maintain their market share, but the overall potential for cash flow is what matters here. And they've been using a lot of this time frame to build up their working capital, and that's where a lot of the cash flow essentially has gone. As you can see, the corrected net margin after adjusting for the R&D puts them in the range of about 7 to 8% in the most recent year versus the 13% last year. So this is why the stock has come down so dramatically. Everyone looked at the 13% last year and said, and they were probably projecting outward saying, oh, well, we're going to keep 12-13% margins forever going forward. That didn't really stick out that way. It's ending up at 7-9%. As you can see, the 3-year average ends up about 10%, and that doesn't take into account we have R&D capitalization to still kind of cover in this time frame here. So we might be looking at more like a 9% number or something like that. I can't remember what I put on the previous valuation I did for this company, but we'll probably get into that when we do all the numbers as a whole. And then on the back of the decline in margins, again, only 1 to 2% growth in revenue this year versus the 53% last year. So everyone looks at that and it's like, oh my gosh, that means they didn't grow. And it's like, well, yeah, but I mean, think about how much demand they pulled forward from the year prior. So even if like you average out these two, that's still like 20% growth per year. And over this entire time frame, they've more than doubled their revenue over this 5-year period. So okay, we'll get back into the call while I continue the rest of the numbers. There is 1 year less than normal for this particular valuation, so hopefully it won't take too long.
As well as expected return to normal promotional levels for the full year, partially offset by factoring higher costs into new product pricing. While freight costs may come down somewhat, we are assuming that they will remain well above normal pre-pandemic levels. We expect the timing of these items to focus margin pressure on the first half, particularly on the first quarter, given high freight costs from late 2021, which flow to the P&L early in the year as products move out of inventory, and margins to normalize somewhat later in the year. We expect our adjusted EBITDA margin to be within the range of 9 to 11% for the year, inside or slightly below our target of 10+% due to the factors I just discussed. And we continue to maintain our long-term target of mid-30s gross margins and an EBITDA margin that grows from 10%. Net income per diluted share is expected to be within the range of 70 cents to $1.20, based on 17.5 million diluted shares for 2022. We expect the gaming accessories markets to produce good growth in the second half of the year as we anticipate a significantly stronger holiday season, a new lineup of AAA games, and easing Xbox and PlayStation supply constraints, complemented by the gaming industry's continued underlying growth. The gaming market is by far the largest and most expansive entertainment industry in the world, and per Newzoo's January Global Games Market Report, the number of global gamers continues to grow and is expected to reach more than 3 billion by the end of 2022. By extension, this drives higher demand for quality gaming products on all platforms and across the 7 product categories we now compete in. So with all signs indicating that the gaming universe will continue to boom, we believe we're well positioned to capitalize on the opportunities ahead. Since 2019, we have transformed from a market-leading console gaming headset business into a diversified gaming and creator accessories business with ample room for growth in a massive total addressable market of now $8.8 billion. Here are our priorities for 2022 in that context. First, continue to lead in console headsets. We continue to lead this category with more share than the next three competitors combined per US NPD data. And we just announced the first set of a new wireless products, our Stealth 600 Gen 2 Max, with new multi-platform capabilities and best-in-class 48+ hour battery life. That's 2 full days you can game on the Max. And the Stealth 600 Gen 2 USB, which keeps the 600's attractive $100 MSRP and adds approximately 10 hours of battery over the earlier version. We have more exciting products coming in our console category, headset category this year. Second, continue to expand our PC gaming portfolio of headsets, keyboards, and mice, and grow our share in that $3.8 billion category. We just launched the Cone XP mouse, which redefines Rocket's fan-favorite ergonomic design and best-in-class versatility. 15 buttons assignable to 29 functions, as well as groundbreaking 3D RGB lighting. I use this mouse myself, and it not only feels and works great, it looks stunningly cool. We will continue expanding our Rocket product portfolio with some more exciting products coming this year. And you'll also see further expansion of our mobile gaming products portfolio. Third on the list of our priorities is to drive growth in the gamepad controller, gaming simulation accessories, and microphone categories we entered last year. We will continue to expand the portfolio of products in these new categories, and together with the above PC portfolio, we expect to deliver roughly $100 million of revenue from these combined categories this year. And fourth, we will continue to identify and selectively pursue other growth opportunities. Our investments in expanding our business in Asia have gone very well and will continue. And we will continue to look for organic growth and acquisition opportunities to expand our addressable markets and drive growth in line with our 10 to 20% annual growth target. Of course, delivering on these priorities requires diligent operational and financial execution with a lean, high-talent team and tight collaboration with our external partners, which are always part of our day-to-day focus. It's an exciting time to be a leader in providing high-quality accessories for gamers across now 7 product categories. We're coming off a record year with great momentum while remaining disciplined and focused on delivering on our priorities for the continued benefit of all of our stakeholders. Finally, as always, and especially given our accomplishments throughout 2021, I want to extend my thanks to the entire Turtle Beach team. Their continued focus, execution, and diligence has allowed us to achieve record revenues while innovating and delivering a record number of new products in challenging circumstances. We have much more in store for 2022 and beyond, and I'm excited to update you all again following Q1. Thank you. Operator, we're now ready to take questions.
Thank you, sir. Ladies and gentlemen, if you'd like to ask a question at this time, you will need to press the star then the 1 key on your touchtone telephone. Now, first question coming from the line of Drew Crum with Stifel. Your line is open.
Okay, thanks. Hey guys, good afternoon. Jürgen, I wonder if you could provide more detail on how you see the console headset category performing in 2022. Your commentary suggests you're a share gainer with your business down mid-single digits, if my math's right. And then I have a follow-up.
Sure. So we see the console headset market declining a bit this year. So and that's driven by the very high first half of 2021, and in particular Q1 of last year. I think console gaming headsets were up about 60% in Q1 2021 over 2020, and our Q1 was up 93%. So we performed really well in Q1 last year, including channel refill and all that, but so did the whole market. And that really went through about half of Q2 of last year. Lockdowns, stimulus checks, all of that really drove an outsized first half. By the way, if we normalize for that kind of extraordinary impact last year, our forecast for the console gaming headset market sell-through would actually be up lower mid-single digits, right? But because of the outside first part of last year, our forecast is actually a modest market decline for the year. Our business will, in terms of sell-through, our guidance anticipates an increase in sell-through year over year, so growth for us in sell-through and share gain, given the new products we have announced and new products we have coming, and the fact that we don't expect to have at least the semiconductor constraints that we had last year as we've redesigned a number of products. That's different than sales, obviously. Sales, our revenues in that category are also just affected by channel inventory dynamics, including the fact that whenever Q4 is weaker than retailers expect, there's less channel replenishment in Q1, in particular as the retailers align their kind of post-holiday inventory levels.
Okay, got it. Thanks. And then just on gross margin, you mentioned a 3 to 4 percentage point hit from higher freight and component costs, but that would abate. I think the language used was over time. Can you clarify that? And also, what is the headwind this year from more normalized promotional spending? Thanks.
Sure. Yeah, our estimate is there's about a 3 to 4% impact from higher freight and some component cost increases. Semiconductors in particular are more expensive, but there are inflationary pressures across many parts of the business like there are for everybody else. Unlike others, we expect, while freight costs may come down over time, and we expect them to come down somewhat this year, we don't expect them to go back to pre-pandemic levels for quite some time. So we are continuing, a very aggressive focus on returning to a mid-30s gross margin, which we expect to, be more in line with as we approach the back half of the year, and certainly would target again for 2023 and beyond by finding other cost reduction opportunities. And we're also factoring higher costs across the board into our new product pricing. So as those products launch and become part of the financials, we do expect to return back on track to our mid-30s target over time.
Got it. Okay, thanks, guys.
Thanks, Drew.
Our next question coming from the line of Mark Argento with Lake Street Capital Markets. Your line is open.
Hey, Juergen. Hey, John. Just wanted to dig in a little bit on operating expenses. I know you guys kind of cranked up OpEx in 2021 to kind of, position yourself for continued growth. Obviously, the market hasn't really given you guys the opportunity to, at least on a console side, grow maybe as quickly as you anticipated. And any thoughts on kind of normalized OpEx kind of going forward, and how much of that OpEx you guys have slated for, kind of marketing promotional activities, and does that maybe change a little bit given the environment?
Sure. So we did, given the record number of product launches last year, our product marketing spend was, several $1 million higher than normal. Every product you launch, no matter what category it's in, has a required amount or a prudent amount of product marketing that happens alongside of it. We expect to continue to launch an expansion in the portfolio in multiple categories, but not at the same rate of 2021, sorry. So that will take the product marketing spend down, some single-digit millions of dollars just as we look at the product launches. And of course, brand marketing will continue across all of the brands, but in a measured way as we were in 2021. So it's really the product-specific marketing that will come down somewhat. So, and then OpEx overall, there are, inflationary pressures on all parts of the business, including OpEx. Labor markets are tight. But despite that, we expect the overall OpEx of the business to come down, roughly $5+ million for the year.
All right, that's helpful. And the kind of the guided, the historical kind of targeted EBITDA margin range. I think you guys talked at 9 to 11% or 10%. You guys are at 9 to 11. Does that 10%, does that give you some decent cushion in terms of being able to reinvest into the business? What's kind of a good reinvestment EBITDA margin versus if you wanted to lean things out a little bit and try to generate some more cash?
I think it is a good balance with the 10%. It's a couple percent below where we'd like to be, and that's all driven by the gross margin line. OpEx, as I mentioned, we're going to make some reductions this year to stay kind of on track with a roughly 10% EBITDA margin. But like any other business, Mark, that our operation expenses include running all parts of our business, including the parts of our business that are growing and expanding. We do very carefully try to balance to produce a good level of profitability. 10%, by the way, happens to be roughly aligned with Corsair, who's 5 times our size.
Okay.
And should actually have a lot more operating leverage than we do. But we run lean. There's not a lot of companies in our category that do more than $1 million of revenue per head, and we're going to keep that level of financial discipline as we go through the year and in our future plans.
And then just last question in regards to semiconductor shortages, in particular more on the console side and the availability of console hardware. Where do you think the market is? Where do you think Sony and Microsoft are in terms of their ability to supply enough boxes of the market this year, and maybe just kind of juxtapose that relative to your guidance?
All right, last 2 years.
Sure. So we don't have good visibility into that, to be clear. They're running their supply chains. They were highly constrained last year, disappointingly so, particularly during holiday. But we are assuming they're going to continue to make good progress. We obviously have to use some estimates when we do our financial forecasts, and we're assuming that the supply constraints abate as we go through the year, and we're hopeful that by the time Q4 rolls around, we expect better AAA game launches and hopefully much less constraint or no constraint on console supplies by that time, and expect that to produce a significant amount of growth in Q4.
Great. It's helpful. Good luck the rest of the way, guys.
Thanks, Mark.
Yep. Thank you, Mark.
And as a reminder, ladies and gentlemen, if you'd like to ask a question, please press star 1. Our next question coming from the line of Jack Vander Aarde with Maxim Group. Your line is open.
Great. Thanks, guys, for taking my questions. Jurgen, you mentioned geographical expansion, and particularly Japan and Korea, I believe. Revenue's growing well over 100% there. Just in terms of your revenue mix as you look forward, any rough targets can you provide what you expect Asia sales mix to represent in the next year or over time, just to put something more quantified material numbers behind it?
I probably won't set specific targets around that, but I will reinforce the fact that we have grown our international business quite a bit. Our percent of revenues outside of North America have gone from 73% of our business to 66%, and that's really progress, not just in Asia. And Asia is still somewhat small, but it's actually approaching double digits now and becoming more meaningful in the overall business. It's also just good progress in other European markets, and we expect that to continue.
Okay, great. That's helpful. And then I believe you estimated supply chain related constraints dragged on your 2021 revenue approximately $25 to $30 million or so. And I think this was due to a certain wireless chipset module in particular. Do you have an embedded estimate for what you expect this certain supply chain issue to to have on 2022 revenue? Is there any implied or embedded kind of impact there?
That's a great question, and I'm glad you asked. We don't expect to have any meaningful semiconductor supply constraints related to that issue for 2022 because we expended an enormous amount of effort and resource at record speed last year to actually fully redesign out of and around that most constrained specific semiconductor. And you're seeing the first of a set of new wireless products with the announcement we just put out in the last couple of days, the new Stealth 600 Gen 2 Max and USB. Those products not only work around that semiconductor constraint, but also deliver an improved value proposition even with 48 hours of battery life on the Max, an additional 10 hours, which is a significant increase, by the way, on the 600 USB. And again, there are more wireless products coming now, and so we think, barring a surprise on the new semiconductors, the new platforms, we expect to have successfully executed around that constraint now for 2022.
Okay, so that is a obstacle or a challenge that is kind of completely structurally removed from the equation now across all your product categories. Is that fair to say?
Well, so we can't forecast what happens in the semiconductor industry overall, so I wouldn't make quite that blanket statement. But there was a very specific semiconductor that was the lion's share of the constraint last year that we have now worked around. We have orders in for the semiconductors we think we're going to need for the year, barring surprises on availability for those semiconductors, which could hit us or anybody at any time. We have factored our supply and semiconductor situation fully into our guidance for the year.
Okay. And then just one more. Of the $100 million target revenue from non-console headsets, is it fair to assume I imagine the bulk of this is, it's rocket related, but is there a number there? I mean, is it like 80+% is kind of what I was thinking. Is there a fair number you're willing to talk about just between your flight simulator and your custom controllers and USB microphones and all the other stuff? Is the bulk of it rocket? Is that fair?
The majority of it is rocket. I wouldn't say bulk of it is rocket. We're not going to provide the specific breakdowns. But suffice, rocket's got a
majority bulk.
Head start.
Not sure what the difference is there, but okay.
Right, and so that's reflected in the number. I will tell you that the other categories, particularly controllers and the flight sim products, which launched during the year versus the microphones, which launched very late in the year, are off to a terrific start and contributing materially to our 2022 guidance and to that $100 million.
Okay. That's helpful. I appreciate the time. I'll hop back in the queue.
Thanks, Jack.
Our next question coming from the line of Martin Yang from Oppenheimer. Your line is now open.
Hi, good afternoon. Thank you for taking my question. My first question is on your OpEx. Where do you see, reflecting on 2021, where do you see higher returns on investments on the new spending on OpEx, looking across new product development, geographic expansion, and some of the marketing around influencers?
Sure. If I understand your question correctly, let me first kind of re-outline what John covered in his prepared remarks. The business grew from $234 million in 2019, 235 roughly, to $360 million in 2020. When that happens, you have to invest in people, infrastructure, resources, everything that's related to the size and scale of the business. But you can't do that, instantly in one fell swoop. So we added staff, resources, facilities, all of that throughout the company during the course of 2020. Those full year, once you hit 2021, those costs then have a full year impact, right? Many that were added late in the year, for example, impact a full year in 2021. That's why, like, the OpEx goes up about 28% for the year, but only about 6 or 7% Q4 over Q4. Because by the time you're in Q4, you've got kind of the full year, you've got the run rate and those resource adds already in. So that's the biggest driver by far of the OpEx increase, just the scale of the business. And then, as we did in 2020, by the way, we continued making investments in multiple parts of the business. We don't break those out. The business is run fully integrated, other than some very specific categories like product marketing and engineering staff for the new products. The rest of the business is run fully integrated and is scaled to accommodate the larger business, including the growth opportunities in new geographies and new product categories.
Got it. Thanks. The next question is on your thoughts on it seems like the second half, based on guidance, you're more comfortable with the growth on the second half this year. Is there any games or broader video game trends you see that makes you more comfortable on the holiday performance this year?
Well, there are two really important items in the quarterly phasing for the year. One is the exceptionally strong first half of 2021, stimulus checks, remaining lockdowns, things like that. Drove console gaming headsets, if I remember right. The market in general, U.S. Retail sell-through up 60% year over year in Q1, right? So, and that a lot of that effect continued into Q2. So Q1 and Q2 for everybody is not going to be a good comp year over year because there's no stimulus checks or lockdowns expected in the first half of this year. So that's a big driver of returning quarterly phasing more to a normal level, which we really haven't had for many years now, because every year for the past few has had unusual dynamics. The second thing is Q1 in particular also has not a sell-through impact, but a revenue impact, just as channel replenishment is lower as retailers get their post-holiday inventory levels back to normal. So all of that kind of affects the first half. The other important item is Q4 2021 was just not strong. The PC, the console market, the PC accessories markets both declined double digits in Q4. Game releases, AAA game releases were weak, lowest review scores, I think, in multiple of those games' franchise histories. Console supplies for Xbox and PlayStation were constrained. That has more of an impact on console, obviously. And then there was somewhat weaker foot traffic, particularly on Black Friday, which is a big driver of gaming accessory sales that day in particular. So because of that, we expect by the time we hit Q4 this year, the game AAA titles will hopefully do a much better job with a set of new launches. Hopefully Xbox and PlayStation will work out of their supply chain constraints. And those two items alone, we think, give us confidence in a much stronger Q4 for the year.
Got it. Thank you.
And as a reminder, to ask a question, please press star 1. Carol, and we have a follow-up question coming from the line of Martin Yang from Oppenheimer. Your line is open.
Hi, Jürgen. Just a quick question on your comment, defining your company as part of the creator accessories business. Does that indicate anything on your non-hardware business? Do you think that you will explore more new products outside of the conventional keyboard and mouse accessories?
Yeah, great question. So obviously the primary product portfolio that's now new for us are the Neat microphones. Those are, major tools for creators and streamers. That's why we've added that terminology, because that's not just a gaming market, that's its own kind of adjacent market. The mic market overall is actually about $2.3 billion. Obviously, gaming accessories, PC gaming accessories, have lots of uses if people want highly functional mice with lots of buttons and things like that. But the primary driver for my use of that language is the.
All right, so we'll go ahead and come off there. Pretty much was about to finish this call anyway. But we're done with our full 10-year history. So starting at the bottom, taking a look at the sales to capital ratio, you can see that, as we were saying before, it stays pretty consistent over this entire time frame up until basically when they first became public after splitting off from the venture capital firm that they were mostly attached to in the previous. So these last few years are basically meaningless. But other than that, you can see they accelerated well above 1 and 2 and then basically stayed above there, hovering even close to 3 at many points. We can use 3-year average or 5-year average. Either way, we end up with a pretty solid number. We'll go ahead and use the 5-year average, slightly lower, and that's just the more conservative way to approach it. Taking a look again at the PE ratio, obviously they were taking a loss for many of the other years prior to the 5-year stint that we had already looked at. So in terms of that, you could say that those few years where it was trading in single-digit PE territory was definitely some of the cheapest points for it, but it is, relatively speaking, pretty cheap right now. And then if you look for an R&D adjusted PE, then overall it's also still pretty cheap right now at 13. Taking a look at the overall balance sheet, as I was saying before, the overall balance sheet has basically just exploded upward in total size in the last 5 years. It's still a really small company, but overall they've exploded upward. Even you can just see that by the amounts of cash that they're carrying on the balance sheet. They're keeping a single-digit amount of millions of dollars worth of cash for 7-8 years, and then suddenly, just in 2 years, suddenly it's 46 million or 37 million, which again isn't a lot of money relative to a lot of the companies that we value on this channel. But compared to having a fifth or a tenth of that amount of cash only like a year prior, it's a pretty interesting suddenly flush with cash kind of situation to have for a company. It's like, imagine if you're a company that normally has only about $1 billion on your cash balance, but now suddenly you have $10 billion worth of stuff to put away. Looking at the overall returns on equity, again, with the overall capital structure not very stable in the 5 years prior to that, it's not super great, but the 5-year period that we have, it still gets a really strong number overall. Again, about 28 to 64% for the 3-year average, and returns on equity goes to 30 to 31% or so. Looking at the overall cash flow, it's still sort of the same thing, that we can really only look at 5 years or so for a particularly accurate measure. And again, it's mostly negative cash flows because they've been investing in the business starting this entire time frame. You can see their overall adjusted net capex, which is all of their total investment, including acquisitions, property, plant, and equipment, as well as R&D that's been capitalized against, including all the capitalization, amortization, and depreciation that can go along with it. This gets us sort of a netted one number figure for each year of how much investment's been done. And overall, you can see that they weren't really doing too much investment. In technical terms, you can see that they were sort of writing off the investment from the previous capital part of their existence that existed prior to IPOing. But then now, in more recent years, you can see a little bit more of investment, though it's even just barely into the positive territory. It's at least in positive territory. It'll probably start to move more positive in the future. So looking at the overall adjusted net margin, which is corrected for R&D, the 3-year average gets us to 9% after we've done all the capitalization effects. A 5-year average puts us down at 7.44, which is actually in line with the most recent year net margin. So that's probably what we're going to use as a base here, since it's so well in line with our most recent year. It does include one loss year in that mix, as well as a couple of really good years. Taking a look at the cost of debt on a rolling basis, it's putting it in at about 10%. We'll probably use the listed number, since that's probably a little too high, but maybe we'll adjust those things a little bit under some circumstances. The tax rate also needs to kind of be adjusted. Maybe we'll just go with the most recent year, since 10% is probably about right in the first place. And then overall, their revenues, if you look at it on the revenue basis, kind of ignoring these first couple of years because it concludes when they first IPO'd, which has a little bit of a weird basing effect on it. You can see that the rolling growth figure they have is in single digits for the first little while, and then it's pushed into the upper teens pretty quickly. Taking sort of an average between those numbers, we get was it 12.67, and the target they're trying to hit for their long-term growth, as they said, was between 10 and 20%. We will take a brief look at their earnings deck to sort of get an idea of that. You can just see they talk about their overall market shares in various industries, as well as the TAM that they're trying to hit in different sections of their market, tracking to $100 million non-console headset revenues for 2022, which is them trying to diversify. And then the long-term targets, trying to drive 10 to 20% top-line growth and deliver on about a 10% EBITDA margin, which means that maybe it might be something in the range of 5% net margin or something over that entire time frame. 5-year EBITDA CAGR through 2021 is over 55%. It's not super meaningless considering the overall time frame of it. But either way, it's mostly that 10 to 20% number that we kind of wanted to focus on. I think they had another line in here where they talked about the overall TAM potential, but maybe that was on their other deck, the outlook piece that I wanted. So charting for that EBITDA, this is the adjusted EPS they're expecting in this next year. So they're sort of expecting to see about the same EPS and possibly even slightly lower in this year compared to last year, which means that we could see even more declines relative to what they had in this year. Overall, like they said, they expect to possibly have their revenues up ever so slightly or flat relative to a declining market group. So overall, they should be growing share, but not necessarily growing the revenue too much, though they are hoping to keep their gross margins back down to where they had been in the past. So taking a look at the overall valuation, let's not pay too much attention to that. We have lots of things to adjust. Let me actually go back on this because I might actually bring that back to. Actually, we'll leave it as is, but the debt levels aren't going to be too affected by it. We'll start at the bottom. Actually, no, we're going to start with my revenue model. My bad. So let's take a look at what I put together for a revenue model for them. Now, in my Corsair valuation, I had come up with a total market size for the gaming peripheral markets that Corsair was in of $4.25 billion in 2021, and Corsair had $647 million of market share in that, which gave them 13 to 14%. I projected that they could get 20% to 5% in a best to worst case scenario, which would give them 1.6 billion versus 425 million in 2027, out of a growth in the market share to about 8.495 billion by that point. So for Turtle Beach, I'm going to assume part of that market share that they can achieve is effectively half as well as Corsair's is, because I do actually have a much more confidence in Corsair as a brand than I do in Turtle Beach. So I gave them 10% and 2%, which correlates to 850 million and 170 million for Turtle Beach in that respective category. Then Turtle Beach is also a part of other peripherals that Corsair is not a part of. And so based off the information that Turtle Beach provides in their S1 and their 10K and in their earnings deck, based off the TAMs that they're assuming, that implies another $3.9 billion of market share outside of this 4.25 that already exists. So that's the extra part of the market that they have a potential for, out of which that same market was supposedly 1.5 billion or so in 2019, and when Turtle Beach had 235 million of their revenues from that grouping, which gave them about a 15% market share. Now I've seen them report that they supposedly have a 30% market share in this grouping, which means I think they might be selecting for a specific subgroup within that market, the high intensity gamers section or whatever, to get that 30%. But either way, I'm going to base it off this 15%. Now, this market is actually expected to grow even more relative to the other market and grow to a possibly $5 billion by 2027. And now out of that entire claim grouping, that gives them relative to the revenues that they had in 2021 of 366 million, which gets them, which again, based off the fact that they had 15% market share in 2019, we're going to assume our market share is based off of that. I'm going to assume that out of this growth, they get to keep the revenues that they have, but they have difficulty growing into the space and the other players come into it, which means that they actually only get to keep about 10% market share in this total pie. And in the worst case scenario, I assume their market share actually collapsed because I consider the headphone part of their business the less solid and easier to fall part of the business, partially because they already have a large market share. So in the worst case scenario, we'll still use 2%, which is basically the same assumption we assumed above. But either way, I think I have some reasonable justifications for using those assumptions. Either way, based off the market share that we're projecting here, that gets us a total revenue for Turtle Beach in this particular section of the market of a 10% best case scenario of 500 million and 2% worst case scenario of 100 million. Add together the two sections of the market that they're participating in, and we end up with a best case scenario revenue in 2027 of 1.35 billion and a worst case scenario of 270 million, which would be 24% growth in the best case scenario versus a negative 5% growth in the worst case scenario. So those are the projections that we're going to build our valuation off of. Negative 5% is already in there. We'll go ahead and just put the 24% in, which gives us an expected revenue growth before we've adjusted for probabilities of 8.83%, although that includes this 5% sort of in the midpoint there. I'd probably maybe put it at 10% because that kind of puts it in the midpoint, or maybe 12%. It's a little bit above the 10% line that they're trying to hit, but not quite the 20%, which gets our expected level to 9.88, and I'll probably adjust the probabilities a bit myself at some point. So that's basically where we're going to start for revenues with Turtle Beach, and then we've got to adjust all the other factors. We will start with the debt to equity ratio at the bottom, like we typically do. There are currently $361 million market cap, and we can see them getting cut in half from where they are currently in like a truly worst case scenario, which may be down to 200 million or so. They only have $800 million right now in total debt, so even if they issued a pretty significant amount of debt, like $50 million or something, which would cover a year or two worth of loss potentials for them, that would still only get them to like a 25% like a 25% debt to equity ratio in like the worst case scenario. So if we put 25% in and then maybe use like 5% for our expected value on the analyst number, that gets us to an expected value of 11% currently, which is still really high. So we'll probably trim back from that even further. We are going to push the probabilities forward pretty significantly, but even so, this is still pretty low debt to equity ratio. Maybe 15. It's probably about as low as I can put it, because it does have to stay up at some sort of consistent level considering the potential for worst case scenarios. So okay, that gets us to 6 to 7% on an expected basis, and we still want to adjust our probability, so that might bring this down to 6 or 5%, which is I think about where we would want it to be for our expected value, considering it's currently at 2%. So now let's move up to the sales capital ratio. Now we've talked about over the last 5 years about a 2.73 sales capital ratio, which means for every dollar of capital invested in the company, $2.73 in revenues is what they managed to generate in total growth. Now their current expected level is at 1. We do have to massively increase this, maybe pushing this up to like a 4 or something in a best case scenario, and then in a worst case scenario, perhaps like 1. That puts our midpoint at 2.5, which if we put this at maybe 2.75, which we're kind of currently at, that puts our expected value at 2.54. Let's see, 2.54 is a bit down from the current level. It's also down from the most recent year, but not dramatically down. I think it's a pretty reasonable expectation to have. The total capital expectations we have at the end also make sense, relatively speaking, and you can see how that dramatically shifted the valuation for us. Now let's move up to margins. We're probably going to have to trim this one back a little bit, as we were sort of talking about in their own expectations. If they're seeing like a 10 to 12% EBITDA margin, then we take into account the fact that that would have to include, we would have to add on the depreciation and then also the interest and taxes from that. They don't really have much in the way of interest and taxes, but I mean, if we just add those things together, we can see that interest and taxes and depreciation and amortization for just this most recent year equaled $8.1 million, 8.124. And then if we just subtracted that from the 27 million, that would end up give us something in the range of like 19 million relative to this. To see, the reported net income was about 18. That would, well, actually no, we should probably just do it off of the GAAP number. My bad, I was actually looking at the my corrected net income margin, but they're talking about their EBITDA, so we should actually use this. So let's say 8.12 off of this, that gets us about 9 million relative to that gets us something close to like a 5%. So in sort of GAAP terms, they're talking about perhaps something in the range of a 5%, which means in terms of what we're saying for our corrected net margin, we would see perhaps maybe 50% higher than that, or 25% to 50% higher than that. So maybe something like a 7 or 8% margin. I'm going to assume that we can possibly do a little bit better than that because of some of the estimation assumptions we're making here. Worst case scenario, I will probably assume a 4%. And then in a best case scenario, let's see what maybe 11% looks like. That puts 7.5 here. I could put 8% on that. That gets us an expected value of 7.5% before adjusting for probabilities. And that's pretty decent. So let's see. Let's take a look. See if there's some weird things that need to be adjusted. Our expected returns on invested capital make sense relative to our recent history. Okay, so let's try taking a look at the probability a little bit. %. Like I might actually even widen this a little bit in both directions. Or maybe not, maybe not. I mean, that's kind of just doing them. Yeah, maybe we'll just leave it as this and then we'll adjust the probabilities for it. So anyway, I'll bring this kind of lesser case scenario down to maybe 15, and then maybe this down to 30, and then shift both those into that case, which would be a 16%. Maybe not as much of that. Maybe we'll bring 5 of it back into the middle. Oh, whoops. Let's take a look. So that brings our expected value for the revenue growth to 10%, so 10 to 11%. I think that's pretty reasonable. It's like just barely above their target, but not like dramatically into their target. The expected value for our net margin is a little bit higher than the most recent year, in line with the 5-year average overall, and it's in line with what they've basically guided towards. Our capital assumptions assume that they actually do have to take on a little bit more capital relative to what they've done in the past for the revenues, but not dramatically so. It mostly just assumes a steady state relative to the last 5 years on average. And then on the debt to equity ratio, we are assuming that they come up to a 6% debt to equity ratio, either by drop in market cap relative to their debt or by issuance of new debt. One or the other, either one's fine. How does it change things if they don't do that? That actually helps their valuation to a degree, not dramatically. So the debt effect basically doesn't have much of an effect at all. So let's see, that might do it. Let me see, anything else other than the default risk to adjust? I feel pretty fine with that. We're fine with the interest rate, we're fine with the tax rate. All right, so let's adjust for default risk, or I should say lack of default risk, really. 0% in the most recent year. They basically have no debt. So, you know, to quote the great Peter Lynch, I don't know if you know this, but it's very hard for a company to go out of business when they don't have any debt. So, not impossible, but a real challenge. So, yeah, pretty much negligible chance of default under most circumstances. We're mostly just using a pretty default or a pretty template based level of default risk. Okay, so that will do it for HEAR, Turtle Beach Corporation. So the U.S. Treasury is selling just under 2%, or it was yesterday or the day before or so. I think it might actually be slightly over that today, but this comes in usually about a day late or so, but whatever. So 2% or so is our risk-free rate. U.S. or mature market equity risk premium that we come up with is 5.13%. The discount rate that we come up for Turtle Beach after adjusting and counting in idiosyncratic company-specific risks, we end up with 8.06%, and they do not have a dividend. 5 years ago, they had sales of $174 million. In the most recent year, they had sales of $366 million, which give them 16% sales growth each year for the last 5 years on average. Sales to capital ratio is 2.73, for the last 5 years on average relative to the industrial expectation of 2.24. So pretty strong on the overall sales to capital ratio. Returns on invested capital for the last 5 years on average have been 26 to 27%, which is pretty dang strong. And on debt to equity ratio, they have pretty much no debt, only about 2%, which basically gives them no real default risk in the most recent year. Profit margins, after adjusting for R&D, we have 7.44% for the last 5 years on average, which is low relative to the industrial expectations that we have for them, 20% or so. So they do have pretty high amounts of sales relative to the capital that they've invested, but lower margins, which is what you typically see for companies that are in higher market share of their respective industry, because usually you have to deal with lower margins relative to your competitors in order to keep that market share, so to speak. But you do end up with higher revenues. Profit in the most recent year of $27 million. That's after adjusting for R&D, of course. And we have the share price selling for $19.32 currently. The probability distribution that we use is pretty heavily tilted into the median case, as well as a decent tilt towards the optimistic end of things, because our worst case scenario is in fact a worst case scenario. Sales in the worst case scenario is $283 million, and in the best case scenario we see just over $1 billion or so. And the expected value we see $627 million, which gets us a growth expectation of anywhere from -5% in the worst case scenario to possibly 24% in the best case scenario. On expected basis, we see 10.6% per year for the next 5 years. The sales capital ratio expectation, we have a distribution of 1 to 4. On expected basis, we see 2.61, and returns on invested capital, we have an expected basis of 24 to 25%. We also assume that they'll likely issue a little bit more debt during the 5-year period, bringing their debt to equity ratio up to about 6% or so. But overall, the default risk on this debt is pretty negligible at a less than 1%, close to only 0.5% per year. The profit margin that we have for them, adjusted for R&D, is a distribution of anywhere from 4% to 11%. On expected basis, we see 7.75%. That gets us a profit distribution of anywhere from $11 million to $118 million in the best case scenario. On expected basis, we see $51 million. That is against the present value price that we come up with after using the discount rate of $26.20 per share, which is 35 to 36% higher than the current share price. We have 5-year forward value targets, unadjusted for any dividends that they could choose to pay out during the period, of anywhere from $8.09 in a worst case scenario to possibly $101.87 in the best case scenario. On expected basis, we see $38.61, which compared to the current share price of $19.32 gets us an implied return of 14.85% per year for the next 5 years. So it's a pretty good return, pretty good sales to capital ratio, okay margin, and pretty great returns on invested capital, which overall combined into a pretty good value score of 1.23, which definitely puts them in line for being of a good buying territory. I had bought a little bit of them not too long ago, like a week or two ago, and I was definitely, knowing that I was going to be doing this valuation soon, I was definitely curious to see whether or not I would be regretting that or wishing I'd been buying more, but it looks like it is in fact a pretty good buy. The short-term pricing metrics we come up with using a regression of fundamentals against multiples for the S&P 500 gets us an implied share pricing of $58, which would be 200% higher than the current share price. So based off of multiples, yeah, it's extraordinarily undervalued, but that's something that we think of as icing on the cake and more of a timing metric to go in line with our cash flow based valuation. So cash flow says it's a great value. Market timing says it's perhaps a great value. The technicals, I guess, don't necessarily say that it's a great value, but screw what they say. We'll probably be adding a bit more to this position in the near future. So that's gonna do it for Turtle Beach. Hey GT, showing up just in time for us to come to a close here. As I had said at the start of the stream, I was about to say, we know that the Shell 40F has come out, so we are expecting to do that as our next stream. We are unfortunately not going to be doing a stream tomorrow on Saturday, when we have been doing third streams for the last several weeks on Saturdays. I do have a bunch of schoolwork I need to do this week as last minute assignments before my spring break starts next week, actually. So hopefully that means I'll have a lot of time for doing stuff next week, but this weekend I'm incredibly busy. So no stream tomorrow, but we can expect Shell to be the one that I'm going to cover on Monday. So if you've watched the stream up to this point and you've enjoyed the in-depth financial analysis that we do on this channel, please give us a like, a subscribe, a share, any of the above. You can find all of my socials in the description below, and you can contact me accordingly. Catch you all next time.